All right, so in our previous session, we discussed the forecasting of the income statement. All right, 1 minute. Let me start the screen share. All right, you guys can see the screen, right? Can someone please confirm?
Yes, Ayush.
All right. So we discussed multiple things in our previous session. We discussed about different revenue models of different companies or different industry. This session is more about balance sheet forecasting, wherein we'll be learning how we need to focus current assets, current liabilities, non-current assets, borrowings, using different methodologies. We'll be learning the working capital approach. What do you mean by CapEx? How do we forecast CapEx? Forecasting of depreciation and interest also, and then how we make a debt schedule, which help us to forecast the interest rate payments. You must have seen that in our income statement, we didn't forecast it finance cost and depreciation, and also the dividend paid and retained earnings. Right, so we'll be doing these as well today. So before starting, we'll be understanding the basic concept of a balance sheet. All right, what all line items are there? What is the understanding of those line items? So let me just quickly get the balance sheet data first. So again, the methodology for getting the data remains consistent. I mean, you need to refer only to the annual report or the 10K report. No other data is accepted. Okay, so just a moment. All right, so this is the data we have from our balance sheet. Again, you just need to go to the consolidated financial statement, and from there you can manually type down each and every line item. All right, so this portion, I'm going to discuss few bit about each and every line item, not into too much detail, but so that you have, so you get a basic understanding, especially for those who do not have a background in accounting or commerce. All right. Okay, so our typical balance sheet has two portions. First is the asset side, another is the equity and liability side. So in the asset side, you see something called the current assets. Okay, so typically what are current assets? Current assets are something which have a longer tenure, okay, almost more than a year. Okay. In this, you typically find two types of non-current asset. First is your tangible assets. Okay. Tangible asset typically consists of your buildings, furnitures, land, or any machinery. Okay. So those are more of a capital goods kind of thing. Capital goods meaning they are the assets which helps you generate cash flow. Again, most of the non-current assets are growth assets in nature. Most of the firm's value we'll find out that is actually driven by the non-current assets only. Okay, so a company who invests more in the non-current asset typically grows at a better rate as compared to a company which does not. And investing into non-current assets is what we call capex or capital expenditure. All right. So when we say that the company is deciding to go for a capex, it typically means they are expanding themselves, and in order to expand, they'll be building more factories, setting up new plants, more R&D facilities will be set up, more patents will be filed, and more employees will be hired. Okay, within this, you see property, plant, and equipment. In our last session itself, I've shown you what all things can come under property, plant, and equipment. Then capital work in progress, goodwill. Understanding goodwill is critical because see, goodwill is something which is one of the most manipulative part of your balance sheet, and it most of the time it is used by the accountants within a firm to make your balance sheet look healthy. Okay, asset rich. All right. So why is that? First of all, goodwill will come under your intangible assets. Okay, it is not something physical in nature. Most of the people think of goodwill as a brand image, but it's not the case. Goodwill is something which comes in your balance sheet when you actually get into merger and acquisition or acquire any company. So let's say the company that you acquired has assets because when you're acquiring company, understand when you're acquiring company, the amount that you pay to acquire that company is called the enterprise value of the company. All right. So most of the people they are confused between what is equity value and what is enterprise value. So enterprise value in short means any price that you will be paying off to acquire any company. Now, when you will be paying a price to acquire any company, how do you pay that? So you take assets, okay? So you take the assets and you subtract the liability, right? So I mean, again, you're not going to pay the liability first of all. So the amount that you pay is actually you pay for the assets, and within that asset you do not pay for the cash also, because you do not pay cash to buy cash. All right, so let's imagine with an example. There's a house in which worth rupees $1 million, and there's $1 million kept inside the house as a cash. Now, are you willing to pay $2 million for that cash, for that house? Absolutely not. I'll be paying only $1 million because I'm not gonna use the cash to buy cash. It doesn't make any sense. So whenever you're buying a company, you actually pay the enterprise value, which is the value of the assets minus all the debt, all and the cash component. Okay. Understood? Now, one thing to understand, the actual formula of enterprise value looks like this. It's the market value of debt plus market value of equity minus cash and cash equivalents. Okay, so you do not pay for the cash. Whenever you buy a company, you get all the things of that company. It's not just asset, I would say, but it's the debt also. So let's say you acquired any company, let's say HUL acquired Minimalist. So Minimalist might be having certain debts on its balance sheet. So HUL will be acquiring those liabilities also. Understood. Now, what is the concept of goodwill? So let's say the value of the assets which HUL acquired from Minimalist was 100 crores worth of asset, but HUL paid 120 crores in order to acquire 100 crores worth of asset. Now, those 100 crore worth of asset will be added to the HUL's balance sheet. All right, but the cash which will be debited, now you have to balance everything, right? So if you're adding something, okay, so it has to be balanced also. So when the 100 crore worth of assets are getting added, that means cash also have to be paid out. All right, so how much cash will be paid out? Cash will be paid out worth rupees 120 crore, because that's what you paid to acquire HUL. Now, sorry, Minimalist. Now, how would you quantify this 20 crores, right? So 20 crores will be getting into the balance sheet as a plug figure, which is called goodwill. Okay, so anything extra you're paying over and above the worth of the company, I mean, worth of the assets of the company, goes into your balance sheet. Now, how do you quantify goodwill? That's a very difficult concept. Okay, so again, goodwill valuation is typically one of the very difficult concept that comes about valuation of intangible assets. That is why it is highly manipulative. So people do play around with the goodwill because you cannot prove anything that what is the value of the goodwill. So goodwill actually captures the synergy component in a merger and acquisition, right? What it states is that when A and B combine, I mean A has a independent value, let's say X, B has an independent value Y. Now when these two companies actually combine, there's some sort of synergy which actually increases their combined value. All right, so the combined A and B value will be greater than individual values of A and B, right? So this synergy quantification most of the time gets captured in your goodwill. That is why, again, as I mentioned, it's one of the most manipulative component in your balance sheet, because no one can justify how you are adding this goodwill. All right, and over the time, and every non-current asset that you see here is subject to depreciation or amortization, except one asset, which is your land. Land is not a depreciating asset. First of all, land is more of an appreciating asset. All right, so that is why every item in your non-current assets has a finite lifetime. If something has a finite lifetime, then it means that its value will be degrading over the years, and that degradation in the value is what we call depreciation. All right, okay. Now, any line item that you see that you have recorded here, okay, this is not the gross value. First of all, the value that we record in the balance sheet section of non-current asset is mostly the net value. What is net value? So let's say this 8625. So there may be within this property, plant and equipment, there may be some asset, for example, machinery. Now let us suppose that we bought the machinery at 100 crore, right? But still, that 100 crore, let's say we bought the machinery in 2021. All right, so we bought it at 100 crore. But again, understand, if let's say if the finite, that let's say the life of the machinery is just 5 years, what it means that every year it will be losing its value. All right, so first year, like we bought it at 0th year. Okay, first year its value will be 80. All right, then it will be 60, 40, 20, and eventually the value will become 0. Understand, we actually report the net value on a balance sheet, not the gross value. All right, so gross value is the actual value at which that asset was brought. But we always account for the depreciated value or the net value. Since since all this accounting and everything is done at the end of the financial year, that is why we consider the depreciated value. Even if you purchase that particular machine in that year itself, okay, we will consider that the value has been depreciated, although it is pro rata in basis. Okay, let's say for the half of the year only the value will be depreciated if you bought the machinery at the mid-year. Make sense? Or similarly, these are the loans first. Okay, these are the loans. Again, this comes under the asset. That means these are the loans which my company gave it to others. So my company here is behaving like a lender. All right. Then you have other financial assets. These could be your company's investments in bond, equity, or any asset which is done for the investment purpose. Okay. Again, I told already gave you the concept of non-current S tax. I mean, deferred tax asset. Basically, if you are paying less than what you're supposed to, or if you're paying more than what you're supposed to, that means it there's a timing difference when the tax will be paid. So you paid today more. That means you'll be paying tomorrow less. For the next day coming year, you'll be paying less. So since you'll be paying less what you're supposed to, it's actually behaving like an asset for you. You will reap the benefit in the coming years. Coming on to the current assets, these are the assets which are more liquid in nature. Okay, these are the assets which you can sell easily in the market. So typical life of these assets is less than a year. When it comes to non-current assets, these are illiquid in nature, not perfectly illiquid, but some sort it is, some value is more of a illiquid because what are illiquid assets? First of all, any assets for which it is difficult to get a buyer. Okay, so buyers are not available. If you have to sell any particular very specific kind of assets, that is very difficult to find the buyer also. So those sort of assets will come under your non-current category. Within current assets, you have inventories, investment, trade receivables, cash. Again, cash is one of the most liquid form of asset. Within your loans, other financial assets, these are the assets which when a company invested in short-term securities. Let's say company bought certain government T-bills or corporate bonds whose lifespan is less than a year. I mean, they can be liquidated within a year time frame. So they are clubbed under your current assets category. Assets held for sale. What do you mean by assets held for sale? I mean, these are the assets which the company is trying to sell. Okay, so once these, since they are companies trying to sell these assets, there'll be a cash inflow which is expected in a year, right? So again, this type of cash flow which is expected from the sale of an asset comes under your cash from investing activities. All right. Okay. Then we'll come to the equity liability. Again, equity share capital. You can see that this value is consistent over the years. One more thing I discussed about the balance sheet is more of a wealth. It tells you the wealth of the company. That is why everything gets carry forward year on year. Okay. Let's say 235 was my share capital in the year 2020. Let's say we added more share capital. Let's say 20 crore share worth of share capital was added. So in the next year, we'll be showing it 255 crores. Again, so it gets accumulated over the year. So there's a cumulative concept which comes when you talk about a balance sheet. So in this case, you can see equity share capital. Again, if you want to know more, understand more about each and every line item, you can refer to the financial notes of that particular line item in your annual report. All right. So in the equity share capital, it tells you when the company went public for the very first time. I have told you there are two ways of financing which the company have. Either company goes for debt financing or it goes for equity financing. When the company goes for debt financing, it basically is taking loan from financial institution or issuing bonds, corporate bonds to borrow money from the institutional investors or retail investors. Whereas when the source of the company's funding is equity, it means that the company is selling its stake. The company is giving you some portion of themselves to you or to the retail investors and getting money in return. Again, I told you the cost of financing varies for whether it's a debt financing or equity financing. For debt financing, it is substantially low as compared to equity financing. Why? Why the debt? I mean, a person giving loan to my company uh, has a lesser risk as compared to a person who is buying the shares of a company. Reason is straightforward because with the debt, there's an always an obligation concept attached to the company that company has to pay the periodic interest or coupon payments to its lenders. But whereas with the equity component, there is no such obligation. The company says that we want to deliver or maximize the shareholders' value, but again, there is no such obligation to the company that they have to return. They have to pay off the dividend. So giving a dividend to the shareholders, there is no mandate on the company. It is completely on the company's management discretion whether they want to give the dividend. Dividends are what? Companies typically trying to share some amount of profit with the shareholders. This is just to increase the confidence of the shareholders or these different stakeholders in the company's decision making or in the company's strategy. All right, so it is a way via which company get certain, company raises the confidence of its investors. So again, that's what I'm saying. The debt is a cheaper source as compared to the equity because debt component there is limited risk. What is the risk here? That the company can default. Again, the chances of company defaulting is very slim, right? But the company has to pay a fixed amount to its lenders every year, half yearly or annually. So that is mandated. So whenever you must have read about bonds. So in a bonds you read like this. So there's a bond which let's say 5-year bond giving a 10% coupon rate. It's $1,000 bond. So what it means that $100 will be given to you as a coupon every year, and for the fifth year you'll be getting back your original amount of $1,000 as well. So again, this is the concept of a bond. It is relatively safer as compared to buying a stock of a company. Another thing is, let's say if a company defaults, then the equity shareholders do not have a uh, preferential claim on the company's assets. It's always the debt holders who have the preferential claim. So the company's assets will be sold first in case of a bankruptcy, and the proceeds from the sale of those assets will be always channelized to the debt holders first. That is why lesser risk and lesser return to the debt holders. Okay. Then comes the concept of your other equity. So other equity is basically your net profit adding over the year. So whatever the net profit, or let's talk about retained earnings. So net profit is something, it's just the revenue minus expenses. All right. So this is my profit after tax. What are retained earnings then? So once the company paid off all their expenses and everything, they have the discretion to pay off the dividends, right? So if the company pays off the dividends, so whatever is left is called the retained earnings. So in the other share capital that you see, it is nothing but the accumulation of all those retained earnings over the year, right? In case if you see that the other equity going down, so you can see in this 50.983 crores or 50,983 crores, it went down to 49,167 crores. So there's a specific reason to why it happened. Because if you see in the income statement, you see my retained earning went from positive to negative, right? Why? Because our company increased their dividend. So although the company was positive at the PAT level, they were making profit at the profit after tax level, but their retained earnings went negative. Why the retained earnings went negative? Because they paid off a lot of dividends. So you see 10.6k was the profit, and they paid off 12.4k as the dividend. So you see they are paying more than the profit. And now from where they are funding this, they're basically funding it because HUL is a very cash rich company. They have a lot of cash on their balance sheet. All right. So from there, they are actually funding this dividend component. Okay. All right. So you can see they had a lot of cash. So in the year 2025, they have 6,000 worth of cash. So they wanted to pay it off to they wanted to deliver it to their shareholders. So they transferred it in the form of dividends. All right. Coming on to liabilities, this is straightforward. These are short-term liabilities. One thing which I wanted to discuss in the current assets is the trade receivables, and there is just opposite to trade receivable called the uh, trade payables. Okay, so this is your trade payable, which is a part of your current liability. First of all, what do you mean by trade receivables and trade payables? Trade receivable means that you sold off certain product of the company, but the money is still not came to your account. Okay, so you paid so the delivery of the product has been done, but you haven't received the cash. So that means you simply like doing like this, buy today, pay later kind of thing. Whereas trade payables is something from the supplier's perspective. Trade receivables is from the buyer's perspective, whereas trade receivables is from the supplier's perspective. What it means is that you are taking the delivery of the supplies, but supplies in terms of raw materials, but you are paying later. All right. So this is the concept of trade receivables and trade payables. Similarly, you have other liabilities, provisionings, tax liability. Again, these are straightforward, not much, not significant on the balance sheet also, you'll observe. Okay. Then you see they have something called borrowings. Again, as I told you, HUL as a company is moving towards debt free. Okay, so ultimately they don't want any debt on their balance sheet. Similarly, you have lease liabilities. Okay, so basically leases means, so let's understand it from a perspective of an airline company. So companies like Indigo, SpiceJet, they actually don't own the aircraft, rather they lease the aircraft, right? So again, leases are also two types. They are operating leases, financial leases. Let's understand the concept of financial leases, wherein you say, okay, I want this aircraft on a lease. So what happens? You actually sign a contract with a company like Boeing or Lockheed Martin, okay, or Airbus, wherein that contract says, okay, you keep the asset, okay, you will keep the asset for, let's say, next 10 years, right? After 10 years, I'll be getting back the, I mean, the companies like Boeing or Lockheed Martin, they'll be getting back the asset. So whenever this type of contract is made between a lessee and a lessor, okay, there's a asset which gets added into your non-current assets called right of use assets. So here you'll see, I guess this company do not have it, but if you look at the company with the like airline company, I've shared the model also of SpiceJet. So if you see, they have a good amount of right of use assets. Now, why this right of use assets is getting generated? Because they are taking a asset, okay, for 10 years time frame. Now this is very similar to depreciation. That means that right of use assets will be depreciated over the course of 10 years, because after 10 years I have to return back the assets. So the useful life that I have with the assets is just 10 years. All right. Now, since it's a lease, you have to pay what? You have to pay interest on that. Okay. So this lease liability basically captures that whatever the value of, I mean, how much amount of that asset you got, and it also calculates the lease interest as well. Okay. So this could be for a short term as well as for a long term. If it is for a long term, it comes under your non-current liabilities. If short term, comes under your current liabilities. All right. Now, if this is done, we'll start with the first thing, which is the working capital. So let us understand few concepts. And again, working capital is very, very testable from the interview perspective as well. Okay. 1 minute. Anyone has any doubt till now? They can ask. Just a moment. I'm rightly audible, right? Can you confirm?
Yes, sir.
Okay. Just a moment. Just a minute. Okay. So where I was making you understand the concept of working capital, right? All right. So typically, what do you mean by working capital? So as the name suggests, okay, a capital which is needed to fund your daily activities, daily, day to day, I mean operating activities. So working capital is more of looking from a operating activities funding. Okay. Now, what is the formula? How do you actually compute the working capital? So working capital general formula that you see most of the places, current assets. So CA is current assets and minus current liability. This is the bookish definition that you see most of the time. right? We'll be getting into the depth of it. I mean, this is very, very important thing. Uh, Working capital can have two values. Either it can be a positive value, it can be a negative value. Most of the people, if I ask, they say, okay, I would prefer working capital to be positive and not negative. Now, let us understand the implication of both of the positive as well as the negative working capital. So, when you say positive working capital, that typically means your current assets is more than current liabilities. One thing more, when you're saying current assets, most of the time I'm referring to current assets as my trade receivables, right? We'll be saying trade receivables from this perspective because this is the major chunk of your current assets. When we talk about current liabilities, we are actually referring to trade payables. All right. Now, before starting with that, I'm going to tell you a concept, and then you yourself can decide what you prefer. I mean, a positive working capital or a negative working capital. Understand? Let's look it from a comparative advantage concept. Now, let's say there are two companies, right? First company is, let's talk about Asian Paints. All right. And another company is, let's take a smaller company, let's say Birla Opus. Recently, you got into painting business. Now, we all know that Asian Paints is a much, much bigger company as compared to any other paint company in India. Other companies are your Indigo Paints, Nerolac, okay, Berger, all those paints. If I ask you, if I ask you, I mean, with respect to Asian Paints, they have they have trade receivables and trade payables. So the company which is very, very dominant in the market, okay, which is very, very dominant in the market, do they need to come up with such kind of a schemes wherein they are paying, wherein they are saying that buy today, pay later? I don't think so. All right. Because they're already so dominant in the market that they do not need to look for buyers. All right. So their buyers base is very strong. They have a lot of buyers already in the market established because they already have that level of comparative advantage. Because of that, they have a good base of customers available. All right. Understanding? Any doubt with this, what I discussed? So one can say that Asian Paints will have a very strong buyer power as compared to Birla Opus. Okay, now this is also referred to as your negotiating powers. All right, so the negotiating power of Asian Paints is very strong with respect to the buyers. Now look from the supplier's perspective. Let's say there are two suppliers. Okay, supplier X and supplier Y. Now these suppliers, they already know. Uh, just a second. Give me a moment. One second. Yeah. So where was that? Okay, let's say there are two suppliers, supplier X and supplier Y. Now these two suppliers, they want to engage with Asian Paints. Okay. Now they understand that dominance which Asian Paints have. Tell me, looking at the dominating power of Asian Paints and Birla Opus, with which of the company will have more negotiating power with the supplier, whether Asian Paints or Birla Opus? Which of the two will have greater negotiating power? Anyone can tell.
Asian Paints, sir.
Exactly. Asian Paints will have a better negotiating power. That means they'll say, okay, you need to provide the suppliers first and I'll pay later. Okay. So looking at the negotiating power and dominance that you have in the market, you actually calculate this working capital, right? So having said that, a very dominant company in the market would typically have a negative working capital because their receivables will be low and their payables will be high. Now, there's another attribute which I want to add to this working capital is that actual definition is current assets minus current liability, excluding cash. Excluding cash. So, in your current assets, I'm not including any cash component. So, it also states that working capital tells you how much extra cash you require to run your daily activities. Now, the benefit of having a negative working capital is that when you have a negative working capital, you have a lot of payables
in your balance sheet. Now, if that happens, it means that you are actually using your supplier's cash to run your activity and saving out on your own cash. So, negative working capital state that you are using supplier's cash and saving your own cash, which you can further utilize it for expanding activity. You can perform capex and grow in a better manner. Understood why negative working capital is better for a company. But if you look this negative working capital from the investor's perspective, they typically look at certain ratios called current ratio, liquidity ratios, wherein they look the ratio between current assets and current liabilities. And there's a bookish trend which says that current assets should be greater than current liabilities to have that liquidity ratio greater than one. But that doesn't make sense in case if a company is having a negative working capital. So again, it is from different perspective. A bank giving a loan to any entity, any institute, typically prefer to have a positive working capital so that in case that the company defaults, the bank can liquidate the company's current assets and get back the money, right? But from an investor perspective, a company with a negative working capital has a better cash generating ability because they're saving out on their cash and they're investing this cash in other growth assets. So when you're valuing a company, you always have to look at from this perspective that how the company is actually delivering the value to its shareholders, right? And how it can deliver is by expanding, right? By generating more cash flow. Okay. Understood the concept of working capital here? All right.
Yes, sir. Sir, are
Hmm.
short-term borrowings and this short-term loans and advances included in the calculation of working capital or not?
It does. It does actually. But understanding which are the major component that plays a role are your actually account receivable and account payables. Moreover, when we'll be forecasting also our current assets and current liabilities, it's not just current receivables and payables we'll be forecasting. We'll be applying the same logic to all the current assets. All right, we'll be applying the same logic to all the current assets except the cash. Right? Cash is separated. Cash is dealt separately. For all the current assets and current liability, we'll be using the same logic. I'll be coming to the forecasting logic as well. I hope this is clear. Why a company prefer to have a negative working capital? It is all about negotiating power. Okay, it is all about operational efficiencies. Right? Even it also makes sense. A more efficient company tend to keep their receivables low because they are good at collecting. Right? They're good at collecting the cash from its customers. All right, from that perspective, also you can understand. Okay, now let us understand one more concept which is there. All right. So, other concept which I want to discuss is here. This is called cash conversion cycle. Okay, so cash conversion cycle. What cash conversion cycle actually means is, let's say you produced any product, okay, then how much times it actually takes to convert that product into cash, right? Starting from the production to the sale and finally collecting the money. So there are three key drivers which drive this cash conversion cycle. First is your DSO, then it is your DPO, and then it is your DIO. Okay, one second. Just all right. So there are three things that we want to discuss. So there are three perspective: DSO, DIO, and DPO. What does each means? Okay. So DSO.
tells you how many days it actually takes to collect the money from your, the people who owe you something, right? So from a company perspective, if let's say there are customers who are owing you, so basically it is referring to your receivable portion only. So how many days it takes your receivables to convert it into cash, right? DPO means how many days it takes to pay off your suppliers, right? I mean, there can be different suppliers. First supplier saying that okay, I'll give you a credit for 60 days. It is very similar to how you use a credit card. So you get a 45 days rent-free period, or a wherein you do not have to pay anything, right? So it is very similar to that. You are using your supplier's cash. Actually, you are taking a loan wherein you do not have to pay any interest. This is the best part. That is why we do not include all these payables in your borrowings, right? While calculating the interest rates. So DSO is how many days it takes for your receivable to convert into cash. DPO is how many days it takes for a company to pay off its suppliers, all right, or pay off its payables. Or DIO is basically how many days it takes to convert the inventory into cash. So how many days it takes to clear off the inventory rather. All right. So DIO typically tend to vary from industry to industry, right? So if you look at a FMCG company like HUL or Marico or TCPL, Tata Consumer Product Limited, therein you'll see the DIO tends to be very small, right? Because more those goods are very perishable in nature. But whereas if you look companies like automotive sector, there the DIO tend to be very strong, very big number you'll see in DIO, because the days it takes to clear the inventory is very large, right? Because not every day those products are sold at in a high numbers, right? Even the shelf life is very higher. It's it's a very significant number as compared to a FMCG inventory, right? So looking at the formula, so if you look at the formula, so DSO stands for trade receivables over revenue multiplied by 365. So again, if you look at DSO, it's a kind of a number. It tells you number of days, right? So full form is days sales outstanding. All right. What is DPO? So DPO is typically trade payables. But as I already mentioned earlier, that we are going to use the same logic for all the current assets, right? Even for work in progress or any small current assets also, we're gonna use the same logic, that we'll divide it by revenue and multiply by 365. So DPO is trade payable over revenue. Many places you will see that instead of revenue, people are using COGS, cost of goods sold, but it doesn't make much of a difference, right? Multiply by 365. Similarly, we have DIO, which is days inventory outstanding. It is inventory over revenue multiplied by 365, right? So what is cash conversion cycle now? If you look at cash conversion cycle, CCC basically refers to DSO plus DIO minus DPO. All right. Now understand this. What value a company will prefer for CCC? Company will tend to company will prefer to keep CCC minimum. Prefer these two to be low and this to be high. Okay. And this to be high. Right? And if you go back to the formula, how this DSO or DIO can be, these values be low only when the trade receivables and inventory portion is small. That is why these type of company prefer to have your inventory low, trade receivable to be low. Whereas if you look from DPO perspective, they want the trade payables to be as high as possible so that they can fund their activities using suppliers' cash. Understood? Now, what is the forecasting logic that we'll be using? So once you have this DSO numbers available, let's say this is your DSO, and let's say for 5 years, so 2020, 21, 22, 23, 24 and 25. So you have different DSO numbers, let's say 16, 18, 17, 16, 15, 14, right? Not 14, but 17 and 17. Typically, why I took very similar number, because this is the case that you'll find with the DSO numbers. DSO numbers typically don't vary much over the years, because if DSO, I mean, you will rarely see any big jump like from 70 it is going from 34. So this type of jump is not what you observe with your DSO numbers. Why is that the case? Because in order to increase or decrease your DSO number, it often involves a big deal in terms of strategy. So there's a huge strategy change which is successful. Then only this DSO number can change. I mean, with a you can see a big jump in DSO numbers. In other cases, it is more or less constant. All right. So once so what you can do is, you can most of the time you use moving average function to compute the forecasted DSO. Now, if you know the DSO number, let's say you know the DSO number for the year 2026, right? DSO number you know, right? Trade receivable you want to forecast, revenue number we have already forecasted, and this is constant 365. Now, if you know this, you can compute your trade receivables for that year. How you'll do it? You'll take this DSO, you'll multiply it by the revenue, and you'll divide it by 365. This will give you the forecasted value of your trade receivables. And same logic we'll be using for other current assets and current liabilities. I hope this is clear. So if this is clear, we'll be jumping on to our Excel. So how we'll start? In order to forecast our current assets and current liabilities, we are going to create something called schedules. Okay, so that working capital schedule will be part of this only. All right, let me just quickly get the structure. So you can see these are the line items which we took from our balance sheet only. Everything is taken except cash. Okay, so you can just compare it also. We have all the inventories, investment, everything except cash. Right. So how many line items are there? There are almost nine line items, and here we have 8 line item because cash is missing. So we are not gonna use this logic for the cash. Okay. Again, the concept of working capital is excluding the cash. Then what we need is the timeline. Okay, so here we have the timeline also. Now let's get the historical data quickly. So we'll link it to balance sheet. So we need the inventories. So this is the inventory, this is the tax and all these things. Just make sure before getting to bank balance, you need to change the formula. Okay, you cannot drag this down. So trade receivables. Okay, we have to skip this cash and cash equivalents. We need to get to bank balances. This is the loans and all these things, right? We can quickly get these numbers and convert into a particular format. So these are the numbers. So similarly, we'll do it for the current liability also. So go to balance sheet. These are our current liabilities. Borrowings we're not gonna take, okay, or we can take also. It doesn't matter. Okay. So let's go to. So we'll get the trade payables first. So again, you see, I didn't took borrowings or lease liability. Similarly, why? The reason is straightforward, because on this we are gonna pay interest, right? So these, anything which on which you are paying interest, any liability on which you are paying interest will be dealt in a different manner. For that, we need a debt schedule. Okay. So let's just get this. I'm gonna drag this down. Check it once if the current liabilities, everything is matching. Okay. So yeah, it makes sense. Okay. All right, now we have all the historical data ready for the current assets and current liabilities. Now we'll be learning how we'll be converting these to DSO and DPO. Okay, DSO, DPO, and DIO. Same logic we'll be implying here. So how do we do that? As mentioned, so we'll be taking this again. The formula which I told are about trade receivables over revenue into 365. That formula is applicable across all the current assets except cash. So you'll be using the same logic. So inventories over your revenue. So from where we can get the revenue? We have it in our assumptions also, and we have it in our income statement also. So we'll get it from income statement, right? We need to fix it so that we can drag the formula. The only thing we need to fix is this row. All right. Okay, and multiply it by 365, right? And since it's not any it's not a accounting number, so it's just a number of days, you don't want to put a rupee symbol. Okay, so we want it in general format, right? If this is done, we can simply drag this, okay, and drag it here. So as mentioned, that you see the number value is very consistent over the years. It doesn't change. I mean, with more or less, you will see only 10 to 15% change over year on year. Most of the time, it remains consistent, right? But if you're seeing any big change, it may be because of certain reason. You see, bank balance number is changing, and I'll tell you why this number actually changed from 40. It went to 9. If you just go to this bank balance, right, you see this bank balance, it suddenly from 66,734 it went to this value, and this number increased. You see this number, you can see. Now the reason why this change happened, because there may be certain short term investment which were liquidated by the company, right? So they sold off their certain investment, they got cash. That is why my cash suddenly increased from 825 to 6,000, right? And my bank balances and other equivalents went down, right? This is one reason. Other reason could be that it could be that I mean they but this reason makes sense. Okay, this is one of the primary reason you are seeing this switch. I mean, the bank balance number is going down and your cash number increasing. So that is why you see this huge change from 40 to 9 also. So that is why we are not going to take these uh, changes in while forecasting, right? So we'll be somewhat, we'll be nullifying this effect in our forecasting. We'll see how. Okay, so these numbers are generated. Similarly, we'll use the same logic here. So we need trade payables, all right, and we'll divide it by the revenue. So revenue will divide, we'll fix this line. Okay, just drag it here, change the format. Yeah, so only thing missing is I didn't put multiplied by 365. Right. Yeah, understood. Now what we'll do, these numbers are generated, we want to forecast it. So somewhere wherein you see there's not much significant change in the historical values, we can simply use a moving average function. So we'll use average and simply average this, right? Same logic we can apply here. So for all these three line items we can do it. But coming here, if you look 2019 24, so it is somewhere between 20 to 24. So I'm going to take this number as constant 22, all right, and I'm going to assume that it will remain constant. For other values, I can here use the moving average, and these also I can use the moving average, and let's just forecast it for coming years. So I'm going to just drag this here. Make sense? Similar logic here also. I'm going to use the moving average function, right? Here also it will work, and I guess everywhere it will work except this portion, because current liability, you see the reason why this current liability number is very high. You see recently this current liabilities was added in the balance sheet. For the previous year this number was not available, right? So given this, I'm gonna take it equal to 0 only, all right, looking at the historical numbers. So this is how I'll forecast. Now I have these DSO, DIO and DPO numbers ready. I'll use this number to forecast my current assets and current liabilities. How do you do that? You take the DSO number and you'll multiply it by the revenue. Again, just simply back calculating everything. So revenue number, because we already have the revenue number forecasted here. So I'll use this revenue number and divide it by 365. Now what all things I'll be fixing? I just need to fix this row, right? So once you fix it, it makes it easier for you to drag everything. Make sense? Same logic here. I'll just use copy paste this, right? Change the formula here from here to here. All right. Okay. Make sense? Right? You see for current tax liability has slowly increased the values. Okay. So now we have current assets and current liabilities forecasted. We'll be quickly linking all these things to our balance sheet quickly. So we'll start with the inventories. So we'll go to schedules and this is inventories. So we have inventories, investments and trade receivables ready. For cash, we are leaving it because cash comes from your cash flow statement and we're going to get the bank balances. Right. We need it for next 5 years. Change the format and there you have it. Same we'll be using for our current liabilities as well. Except borrowings and leases, we'll start with the trade payables. So we'll go to schedules, get the trade payables. While connecting, make sure you are connecting for the right year, okay? Else it will create an issue. All right, so this is also done. All right. Now, next thing that we'll be working on is our non-current assets. Now, which long current assets to value? Okay, to forecast using capex approach. Not every non-current assets can be valued, right? For other non-current asset which we cannot value, we'll be using a different approach. But let us look at what is the approach we need to follow. So let me just get few numbers first. Get the format. Okay. So this is how the capex schedule looks like. The dates. Okay, so you can see these are the numbers which we already have. You see, we do not have all the uh, assets, all the non-current assets. Only few current non-current assets I have listed here. Okay, you see, we do not have goodwill or other intangible assets as well, right? So there's a reason to why we have done it like this. Now, first of all, how we'll get all these values and everything. Okay, so all the details. There are three main details we need for every non-current assets. The first thing is we want there what is the gross value, right? So what was the actual value that was there? Then we want the accumulated depreciation. So how much depreciation have happened over the time, and then we want the net value. So net value is already available to us. All right. All we need is gross values of these assets and the accumulated depreciation over the years. Okay. So before getting into that, just wanted to show you how this accumulated depreciation things work. All right. Okay. So let us understand the concept here first. All right. So let us assume that you purchased an asset, the value of that asset at the time you made the purchase was, let's say, 100 crore. Okay. So this was the gross value that you have. Again, capex schedule is one of the most complicated. So, if in case if you have any doubt, do ask me immediately. All right. So this was the gross value that was there, and could be some machinery. Okay. So let's say this is some machinery. Now let us say that the useful life is 5 years. All right. So I made this purchase in the year 2020. Okay. So in the starting of the year 2020. Right. So what I want is I want the net value. Okay. Here we can have the gross value. There are three things. First is my gross value. Then I have the net value. Then I have the depreciation. And then I have the accumulated depreciation. Okay. So these are the things which I need. So 2020, 2021, and 2024. 5-year data. So again, gross value remains same. The gross value can change only in one other way. Only if you're buying some more stuff. Let's say you are you're buying more machinery, right? Then only this gross value can increase. But for now, I'm not buying anything. So my gross value is consistent. It is not increasing or decreasing. Net value. As I told, the useful life is just 5 years. So that means, and let's say the depreciation, so we are following is a straight line depreciation. What happens in a straight line depreciation? The amount of depreciation is constant over the years. So if the useful life is 5 years, that means I'll be losing 20 crores every year. All right. So there'll be a depreciation of 20 crores. So you can see I use the same amount of depreciation every year. So this is called straight line depreciation. Now looking at the net value. So every year net value it will lose. So I purchased this asset in the starting of year 2020. So I mean when I'll be reporting this on my balance sheet, how much value I'll be reporting? Only 80. For this I'll be reporting 60, 40, 20, and here I'll be reporting it as write-off. So none of the values remain. What is the accumulated depreciation over the years? So in the first year, the accumulated depreciation is 20, then it will be 40, 60, 80, and 100. So one thing you can observe is how you're getting to the net value. So net value for any year, how do you compute it? You're actually taking the gross value, which is 100, and subtracting the accumulated depreciation. All right. If I want to know what is the rate of depreciation, how I can get it? So basically, you will just look at what is the gross value, all right, and how much is the depreciation. So looking at the depreciation over gross value, that this will give you the level of depreciation. In this case, it is 20%. Understood this logic? How this depreciation is actually working? What is gross value? What is net value? What is depreciation? What is accumulated depreciation? So what we need is what things which are not available on my balance sheet is we don't know what is the gross value and we don't know how much is the accumulated depreciation. This depreciation we can get it from our income statement. Okay, but other things, even net value also we can get from the balance sheet. But for these values, we have to do certain efforts to get these value. And from where we can get these value? Gross value also from the notes and accumulated depreciation also from the notes. But understand one thing, for all the non-current asset, these details might not be available. I'll show it to you. Okay, so now I'll quickly go to our annual report. So let me just open the annual report. 1 second. Okay, so I'll quickly go to my consolidated balance sheet. Okay, so just consolidated financial statement. Okay, so within this, first of all, I need to look at which notes I have to refer it to. So let's go to all the non-current assets. So you can see the notes are given. So 3, 4, 5. Okay, all these notes are given. So let us look at all the depreciation and all these details. So we'll start with note number 3. Okay, which is for property, plant, and equipment. So if you go down to property, plant, and equipment in note number 3, you can see these are the details that we have. Okay, this is our note number 3. Okay. Okay, so note number 3, they have broken down the property, plant, and equipment and capital work in progress. So as I was mentioning also, we have something called leases, wherein we get an asset created called right of use. So you can see we have the right of use assets also. All right, so it is a part of my property, plant, and equipment only. They haven't given it separately. That is why we were not able to find in a balance sheet. But it is actually comes under your, property, plant, and equipment only. Okay. So understand how they have broken down. So you see our property, plant, and equipment value is 8625, right? This 8625 is actually divided into two components. First is my owned assets, which I own myself, and other is the leased assets. Now, when you are leasing anything, there will be a right of use asset line item created on your non-current assets. Okay. Again, for how many years? Let's say you are getting those lease contract for 10 years. So this right of use assets will be depreciated over the course of 10 years. So after 10 years, the value of those assets will become 0. Understood? Now, what all things come under these assets? So factory, buildings, plant equipment, furnitures, and office equipment. So you see different useful life we have here. Okay. So you see 30 years, 60 years, but we'll be looking at a combined value. Okay. So we're not going to break down these values. All right. So it will become very complicated for us to calculate everything separately. Rather, we'll just look at a very broad level. So we'll look at a total PP and E level. Okay. Property, plant, and equipment. You see, this were the value. So these number, what you're seeing now, this is the gross value. So gross block will give you the gross value. So what is the gross value at the starting of the 2025? This is 12,004. Okay, this was the gross value, right? But what is the value we are reporting? We are reporting 6941 as the net value. So because there is a depreciation. Now understand why these values, you see these values started with some different value. Okay, but over the time they actually increase. So in the year 2023 the value was almost 11,000 crore, but in the year 2024 it increased to 12,000 crore. I mean, sorry, in the year 23 it was 9663, then in the year 2024 it was 11,000, and then now it is 12,000 crore because the company is doing certain capex. They're adding new equipments, they're adding new employees, and they're adding new machinery and everything. So that is why these numbers are increasing. Look at the accumulated depreciation, right? So if you look at, this is the accumulated depreciation. So these are the two values which we need. So we need the gross value of my PP&E and we need the accumulated depreciation. So if you subtract the accumulated depreciation from the gross value, we get to 6941, which is our net value. Understood? Right? If you look back to the actual. So again, we'll be doing the same exercise for all the years and getting the gross value as well as the accumulated depreciation value. So if you'll go back to our actual. All right. Now what I did here is that the PP and E is actually broken down into two components. First is my owned assets and then is the right of use assets. So you see those gross value and accumulated depreciation value were given for our for my property, plant and equipment. And also let's look at whether it is given for goodwill or investment accounted and all these other line items. Can we find all this depreciation and other values? So again, go back to our report, right? So this is for the PP&E. Now let us look at, so again within PP&E you have two components, you have the owned assets and you have the leased asset. So this is for the owned asset and this is for the leased asset. So we'll be using all these, we'll be basically dividing a property, plant and equipment into two components and using the numbers respectively. All right, so this is for the right of use assets. Again, this was the gross value and this was the accumulated. Only two things that you need. You need just the gross value 2878 and you need the accumulated depreciation value for that particular year, right? If you look at capital work in progress, you see nothing is given here. They're just given the opening value and balance. They haven't given the accumulated depreciation. So again, we cannot apply that same logic for the capital work in progress. So let us look at another non-current assets, okay, which is our goodwill. So for goodwill also, you see they actually gave us the balances, okay, but they haven't they haven't given other things which is needed, right? Moreover, if you look at the goodwill for our company, you'll find out that they haven't actually depreciated the goodwill. First of all, goodwill is not depreciated, is not the right term. Goodwill is something which is tested for impairment. Goodwill is something which is tested for impairment. Basically, you look at what is the goodwill of your company in the market, right, in the current market scenario, and what is the goodwill value in your balance sheet. If there's a difference, you actually write off that value of goodwill. All right, so it is tested for impairment. It is never depreciated or anything. So in our case, we found out that the goodwill value is actually not changing over the years. So that means it is not getting tested for impairment. So that is why we're not gonna depreciate it on anything as of now, whatever looking at the history. All right. Looking at another non-current asset, I mean, see, these investment were also non-current, but again, investment is something that do not depreciate. So again, we cannot use this as well. All right. So if again, so the whole logic is what all items you need to put into your capex schedule are the items for which you can easily find out what is the net value, what is the gross value, and what is the accumulated depreciation value, especially the gross value and the accumulated depreciation value. Okay. If these things are available, then only you can put them in the capex schedule. So get back to capex schedule. So quickly, I already have the values and everything ready. I'll be getting all those values. Okay. So we'll start with the gross values. So these are the gross values. Again, don't get confused. I have broken down the property, plant and equipment into two parts. First is my right of use and other is the owned. Again, they have separately given the values of these two in the balance sheet notes. Okay, so don't need to worry. These values are nothing but what is available in my balance sheet. So quickly I'll get these values. So property, plant and equipment, these are the values, right? Other intangible, I can get the value. Okay. Let's look at what is the breakdown of owned and leased. So again, this is also was available in the this was also available in my balance sheet. Can you guys see the balance sheet? Hello. Okay. So I'll get it from my balance sheet quickly. But the sum of these two will be equal to my property, plant and equipment only, which is my balance sheet, right? So you see, if I add these two, it will be equal to 6116, which is my property, plant and equipment value. But only thing is that I'm bifurcating them. Okay, now I also got the value of accumulated depreciation. Again, same area of my balance sheet. So I'll get those as well. All right. So what is my total gross value? It is the sum of all these values. I'm going to use the sum function here. Right. Similarly, for the accumulated depreciation also. Now, what is the net value? How you can get to the net value? These are the net value, or other ways to take the gross value. Okay. Take the gross value and subtract the depreciation, accumulated depreciation. So this is also how also you'll get to the net value. Okay. What is the total net value? It will be sum of all these. Why I'm calculating the sum of gross values and accumulated depreciation, I'll come to that later. Okay. Now, what is the depreciation for the year 2021? How we can get that? It is from my income statement only. So these are my depreciation values. Now, if I want to know how much, what is the rate of depreciation that was charged? Okay. How I can get that? So in order to get to the rate of depreciation, you need the depreciation value. You need to divide it by total gross value. Okay, so this is my total gross value. So this was somewhere close to 3%. Let us look for another other years. So you can see it is consistent across the year. It is consistent at 3%. All right. So typically they are using a straight line depreciation method. Then for the coming year also, I'm considering it to be 3% only. Okay. So this is the rate of depreciation that I got. Understood. Now, understanding one more thing, what is total capex basically? What is maintenance capex and what is growth capex? So maintenance capex, understand this depreciation is actually a non-cash item. Depreciation actually tells you how much money you need to put it back into your business, especially in those assets which have been depreciated, to bring it back to its original form. So it is basically the wear and tear cost and service cost. All those things will come under your maintenance capex. All right. So what I can say is my maintenance capex is nothing, but it is the depreciation only, right? So whatever is the depreciation that will go into my maintenance capex, right? So this is my maintenance capex. Is it fine? Right. Now, one thing I want to identify, I want to tell you is one difference is instead of, so see, let's say this was my depreciation for the year 2021, but this cannot be my maintenance capex for the same year. My maintenance capex actually starts from the next year. So this much amount was depreciated in 2021. That means in next year I have to put it this much amount into those asset, right? So this becomes my maintenance capex. So the depreciation for the year 2021 is actually the maintenance capex for the year 2022. All right. Now, what is growth capex? Growth capex basically means any extra investment you are doing into your business. Either you are increasing your property, plant and equipment, those type of assets. How you can get that value? So basically, if you see there's an increase in the gross long-term assets. So yes, there is an increase. So this is how we can compute the growth capex. Till here, any doubt? Then what is total capex? So basically, total capex is nothing but the sum of your growth capex and your maintenance capex. Okay. All right. Now, what I am assuming is going through the management discussions and everything. So you need to forecast how much capex the company is deciding to go for. So for the ease of our understanding, I'm just expecting a 500 crore capex is what the company will be doing every year, right? So this is the amount of capex which the company will be doing every year. Okay. So again, this is my forecasting assumption. So this is the assumption part in this entire capex schedule. So what my total capex will become this much. Now I need to forecast my maintenance capex now. What my maintenance capex will be for coming year. Now looking at this, gross long term value and also this accumulated depreciation value. Accumulated depreciation value, if you want to compute for next year, how you can do that? It is basically the previous accumulated depreciation plus depreciation for this particular year. So it will be this year, this value, right? Correct. Now, how can I get the gross long term value? It is basically the previous year plus any extra capex done this year. So I'm doing a capex of 500 this year. So I'm gonna get to this gross long term value. Understood how you get to the gross long term value? I mean, sorry, it is this value. Yeah. So whatever the value you have for the previous year plus any additions or subtraction to my capex, right? So how I computed that? So this was my previous year's gross long-term value, and this year what is the total capex I did? So again, always add the total capex, not just the growth capex to my gross long-term value. So I got the gross long-term value. Can I get to the depreciation? Because I already have forecasted the rate of depreciation, I can get to the depreciation value. Basically, I need to just multiply gross long-term value with my rate of depreciation. So this gives me the total depreciation. All right. So again, what my accumulated depreciation will become? It is the previous accumulated depreciation plus this year's depreciation. All right. So what I'll do, I'll quickly, you see, if I'll forecast this, if I just drag this and drag this, you just need to drag all these things and automatically everything will be populated. Drag this and also drag this. So you see things are already getting populated now. Okay. Now we need the own, leased and other intangible assets. So logic, so this is the logic I actually computed gross long-term asset at a very broad level. So we'll be dividing this gross long-term value across these three assets in the similar proportion. So we'll be using proportion logic. So how much is the proportion of owned in this total gross long-term asset is this divided by total. So this is my ratio, right? So I'm going to fix this ratio. Basically, what I'm going to fix is this 7. Actually, both of these. Okay, so I'm going to fix this. Also, I'm going to fix this. Okay, and this is the ratio. If you'll be dragging it, yeah, this is the ratio, and I'll simply multiply it by this year's total gross value. Okay, and I'm going to fix this 7. Okay, so now you can simply drag this. Okay, all right, so I can now simply drag this, right? So you see the values are very similar and I can simply drag. So that is why be careful while applying the formulas. Okay. So if you check this value, how it came, it basically looked at the ratio and it multiplied it by this year's gross long-term value. I'm going to use the same logic for the accumulated depreciation as well. Okay. Just change the formulas depending upon the sales value. All right. Just drag this and drag it here. Okay, for net value, it is straightforward. We just need to subtract the gross value and the accumulated depreciation value. All right. So you see, we have forecasted all our non-current assets, for which we had the required data available. So I'm going to link it now. So get to the owned value, and this is the leased value, and this is the other intangible assets value. So these are the values which we have now. Right? How we can get to the total PP&E? It is the sum of this value and this value. So we have successfully forecasted our property, plant and equipment data as well. Now you can play around with all these things. Okay. Uh, I mean the rate of depreciation or anything else. Okay. So you can play around with all those things. That is totally up to you. One second. Hmm. Also, you instead of taking this 3 as fixed value, because if you just look at it at a decimal place level, you see the values are different. So I would rather use an average function here. Okay, so I'll use the average because again the values are very very sensitive to this depreciation rate. Okay, okay. 4871 is my total PPN E which I got. Now I'll quickly backlink all these things to my actual balance sheet, right? So we have the PPNE ready equals to go to schedules, and we also have the other intangible assets. Okay, just forecast this, convert the value as well. All right. So this is how we'll make the capex schedule. Now coming on to a third schedule, which actually help us to forecast our debt component. I mean the no long-term current liabilities. Okay, those type of components we'll forecast it using the debt schedule. Okay, so let me get to the pattern. So typically for getting to the debt schedule, what we need is we need the long-term and short-term borrowings. We also need to see if there's any extra debt added or subtracted. Okay, then we need to look at the finance cost in our income statement, and from there we can fetch the rate of interest that we are charged. Okay, so just get the dates. All right. So let's get to the long-term and short-term borrowings first. Again, for long-term borrowings, I'll refer to my non-current liabilities. Okay, so let's go. So you see in the non-current liability, we do not have actually long-term borrowings. You see, we do not have actually long-term borrowings. So, but what I want is always think of it to for making your model future ready. Okay, so I'll still keep this portion. Okay, right? But I'll make it 0 for now. Okay, but I want to make my model future ready so as to incorporate any new information which is getting added every year. For short-term borrowings, we do have, right? So short-term borrowings we'll get it from my non-current, I mean current liabilities. Okay, get this. You can see we have the values, but the values are very, I mean very very small. But always think of making your model future ready. Okay, so in case if any data comes up, you can add the data and perform this valuation exercise. Okay, let's look at from a lease perspective. Okay, so we'll go to again go to balance sheet. So this is my lease, long-term leases. Okay, and then we also have the short-term leases. And we can get the sum of total leases. Excuse me. Okay, all right. Okay, now we need to look at the total interest first of all. So because we need to see, like you see on the income statement, you see just one single finance cost, but this finance cost is actually coming from different areas. You are paying interest on the leases as well. You're paying interest on these borrowings as well. So if you want to understand from where this finance cost is coming, we need to refer to our uh, balance sheet or the income statement notes. Okay, so what you need to do, just go to your income statement. So within your income statement, you go to this finance cost, which is note number 33. Okay, you can find all the data. So I'm going to show you note number 33. So you see this finance cost is coming from different. So interest expense of loan on bank overdraft, right? This is for the short-term loans. Then unwinding of discount of provisions and liability, interest on leases, interest on taxes. All right, because if you have tax, I mean I mean deferred tax liability, therein you have to pay interest also, right? So you can see there are different areas from where this interest is getting calculated, but we are not concerned. Like we need not to go into this much detail. Okay, so see how we're gonna do this. But just for your knowledge, I'm showing you what all things are there. Okay, so I'll quickly get all these values. Yeah. So these are the values which we have. Now just look at it. What is the total interest? And this total interest will match from your income statement also. Uh, Just check it also whether it is matching or not. All right. So you see your total interest that you paid in 2025 was 395. So let's just check it from income statement. You see 395 it is matching. Okay. Now what we need is what should be the rate of interest, right? Because in order to compute the finance cost, you need the rate of interest. So how do we do that? First of all, there are certain assumptions we'll be making with respect to how much will be the borrowings in coming year. Okay, how much borrowing we'll be having in next years. So again, as I told you, we are planning on to go debt free. So I'm suggesting my long term borrowing will remain zero. Okay, and I'm also expecting my short term borrowing will also become zero. So that means we are practically going debt free in case of borrowing portion. So this is my total borrowings. Let's look it from the lease perspective. How much lease we are planning to raise? Okay. Okay. So you see, for that particular reason, I have created this two rows as well. So because net borrowing raise, I'm making it as zero. Okay. I'm not going to raise any new debt. Uh, and for forecasted year also, I'm making it zero. Either you can do like this. Even for the net leases, how much lease we are planning to add, what we can do is we can just look at it how the leases have evolved over the time. All right, so based on that, we can add or subtract amount of leases. Okay, so let us see how much is the net lease was added first of all. So how do you get the lease as it added? Basically this year minus previous year total lease. Okay, 34 crores of net lease was added. Now this is the lease we can see. So what I'm expecting that 50 crore lease will be added every year. Okay, this is my assumption. If this is the assumption, so what will be my total lease for this year? It will be 1647 plus the new lease added in the coming year. So this is my lease data which I have, right? I can divide this lease into proportion logic, same logic which we use for gross long-term depreciation, like gross long-term value and accumulated depreciation computation. Okay. Similarly for the debt also, if you want to compute what is the debt added, you do this. So it is this minus this value. Okay. Although you will see some certain number, but what I'm assuming that in the coming year it will become zero, right? So again, that now we need to divide this total leases across short term and long term. How we'll do that? We need the ratio this over this value, right? I'm gonna make this value fixed, right? And we'll multiply it by this value. Just drag this and drag this. All right, so we have computed our short-term lease and long-term lease as well. Now we need to compute the interest portion as well. So for getting the interest portion, everything, we need to know what is the finance cost rate first of all, right? So again, for the cost of borrowing, it is very straightforward. It will be zero. All right, so I'm assuming it's zero because you see we don't have any borrowing, so just zero. So what is the cost of lease? Basically, how do we compute the lease? It is the total lease, okay, whatever the lease you are paying. I mean, it is the total interest that you pay on the lease, which is 80 crore over what is the total value of leases. So this is the rate of lease that we have. It is somewhere around close to 8%, right? We can do for coming years as well. Now I'm assuming that will remain 8% only. Okay, so I'll just link it to this. So this is how we forecast our interest rate. One another way is to look at the forward interest rate. That data you can easily get, but again, that forward rates are only available for 1 year data. 5 year forward rates, that doesn't make any sense because 5 year forward contracts are not very liquid in the market. 1 year forward rates are still very liquid. That is why that will make sense. Okay, so this is how I'll get to the cost of leases. This again, it will remain zero. So we can consume, we can obtain this interest on lease liability. It is very straightforward. It is the rate of lease, all right, multiplied by the total leases that we have. So you see, this is how we are computing the total interest portion. Now for all these portion, all right, so I'm going to assume that this will remain constant over the time. I'm not playing around with these. I'm not forecasting it, I mean, that manner. I'm assuming this will remain constant. This also I'm assuming it will remain constant. So this basically becomes my total interest component. So I have forecasted the interest component as well. Okay, interest component done, lease forecasting also done. Okay. Okay, we can also obtain the weighted average cost of borrowing. It is simply basically looking at the lease and borrowing together. Okay, so how you can do this? So what is the weightage? I mean weighted average. How you can do that? So what we need is we need the total interest, all right, and we need to divide it by total borrowing versus total leases. So how basically it looks. So this is the total interest, and we divide it by total lease plus total borrowings. Okay, and it has to be in percentage. All right, but this doesn't make any much sense because we know that there is absolutely no weightage of borrowings or debt in my balance sheet. Most of the debt, I mean the interest cost is actually driven by my lease component only. Now all these things which I've computed, I'm going to link it to my income statement first and also to the balance sheet. So with the income statement, there are two things which I need to link. First, let's link this finance cost, which is your total interest. All right, and also I'm going to link the depreciation. So in our schedules, in our capex schedule, we have also computed this. This is our depreciation, so we will be linking this as well. So this is the depreciation goes. So almost all the line items in our income statement are done now. Okay. Right. Just go back and link our leases and other things also. Okay. So you see we have borrowings and lease liability. We'll quickly link it with our schedules. Uh, so this is our short-term borrowings comes here, and lease liability again, these are short-term leases. We'll go to these, and so this is a short-term leases, right? So this is also done. Now coming on to a non-current item, so we have lease liabilities. So we'll go to schedules. These are my long-term leases. Okay, so this is also done. Now there are certain line items still left in my balance sheet. For these line item, okay, I'll be dealing them separately. So we'll create a header called other balance sheet items here. So in our assumptions itself only, we'll create a line item called other assumptions. Just get to this. So these are those items which are not the part of my either of these schedules. Either it is capex or I mean it is capex or anything. Okay. Okay. So what all these line items are? So these are those balance sheet line items which are not the part of any of the schedules. So these are the line item for which we don't find anything in the schedules. We'll quickly get all these numbers. Okay. So we'll start with the balance sheet. So we'll start with the capital work in progress. Right. So this is goodwill. Now we need other, which is investment accounted. So again, investment account. You see for the goodwill also, that's what I'm referring to. You see it is very, very consistent over the years. There's no impairment testing done for the goodwill. Okay, we'll get this. Then investment loans, all these things, non-current assets. So we need till non-current assets to one other non-current assets. So this is the data we got, and let's do it for the liability section also. So other financial liability, go to balance sheet. So again, these are the things which we didn't forecasted in our working capital schedule or in the capex schedule. So we'll start with this. We have provisions and we have all these things. Okay. Now for these, we're not gonna waste much of our time. Things are very, very straightforward with these line items. I'm simply gonna assume that these line item will remain constant over the year. So no change in these line items. Okay. You can play around with it. You can do more research, but for your ease of understanding, as of now, I'm not assuming that any of these assets value will be changing over the years. Okay. All right. So this is also done. Now, if you want to link it to the balance sheet, we'll quickly do it. So go to assumption. Just drag it. Things may look, I mean, very laborious or very boring, but once you yourself will do it, things will look much better. Okay. So again, that is why it may be slow. I would request you to watch it at a 2x speed. That would be better when you'll be working it under it. All right. So we'll quickly link these components also. Drag it. Same logic here. Other financial liabilities. Drag it. Done. All right. So within balance sheet, now only one item is pending, which is your uh, equity section. So what is left as of now is just my equity portion, and within your income statement, there's this dividend and retained earning, which we'll do it in the next session. So in the next session, we'll be focusing on these line items and along with that, the cash flow statement. All right. So once that is done, we'll quickly jump to a DCF modeling. Okay, so that's it from this session. I'll be sharing the videos along with the working file. Okay, thank you everyone for joining.